Hello everyone. Today we're going to continue on with Unit 1 of Diploma Business Management with profit-based organizations, companies, also commonly referred to in the literature or the media as corporations. As you can see, this is an assessment objective 3 point of the syllabus, which means it has the potential to come up in those 10-mark questions where we have command terms such as evaluate, discuss, etc. And I can say from experience that this is a topic that does come up frequently in those type of questions. So, a company or a corporation. It's a business that's owned by its shareholders. And in fact, most of the businesses that you encounter on a daily basis are structured in this fashion as a company. By buying a share in a company, the person or the company is investing in that business and they're looking for a return on their capital. Yourself, if you're into it, or your parents or someone you know, probably buys shares as an investment and is looking for a return. As I mentioned, other companies can own shares in separate companies. This is very common in many industries where one company will own a percentage of another, which can have occurred through merger deals or all kinds of mechanisms. Private limited companies, the first type of company, these are shares privately held and not available to the general public, which is extremely common in family-run businesses. This might give you the idea that we're talking about small businesses here, but there are actually very well-known large companies that operate as private limited companies. IKEA is a big example, Lego, or one that I think is quite amazing is Mars, the maker of Mars bars and a whole variety of other candies. These are all private limited companies. And in the case of Mars, it's actually very much family owned and has been for the last 100 years of the company's existence. These structures, they really are limited in the number of shareholders that they can have, simply because there are agreements in place where the sale of shares requires consent from either all or the majority of the existing shareholders as a way to keep a family business in the family. The legalities of setting these up varies by country, but one thing that remains consistent everywhere is that it is limited liability, hence the limited in the name of the company. What limited liability means is that the liability of the owners has a limit. There is a separation between the company and the individual. In other structures, this is not the case. And if the business were to go bankrupt, the individual can be chased for the debts of the company. The establishment of a company or a corporation introduces that separation and protects the owners of the business, legally speaking, from legal actions brought against the company. Public limited companies also have limited liability, which is a benefit of both of these structures. A public limited company has essentially gone public via an IPO, which is an initial product offering. By doing this, they're allowing just the general public or anyone with an interest to buy shares in the company. What this does in general is it unlocks more capital, more potential capital, more potential investment. Now, this can backfire on companies because by going public, they have to make their finances public as well. And a business that might be on the surface doing well can actually not be doing so well once we dig deep into the financials. This famously happened in recent times with WeWork. It was venture capital funded. It was privately held by the founder, the investors, and the financials went public. When they went to go public via an IPO, they had to divulge the company's finances in detail. And in the days and weeks leading up to the initial sale of the shares, people started to ring the alarm bells. They went through the finances, and not all was as it had seemed. The company was actually in a very poor financial position, and everything kind of exploded. The company lost billions of dollars of its valuation. One feature of public limited companies is that we have a board of directors which are elected at an annual general meeting. You might also see this called as an AGM. The directors are there to represent the shareholders. Unlike private limited companies where the shareholders are often quite intimately involved in the business, maybe a family business, the shareholders in a public limited company have a limited say. They, of course, help to elect the board of directors, but this is more strategic level guidance. They don't really have much of a say in day-to-day operations. Like all investments, people who buy shares in public limited companies are looking for a profit. Profits are returned as dividends, which is a share of the profit at the end of the quarter, typically, or the year, if there's been a profit. There are sometimes tax advantages to the company not giving dividends and instead buying back shares or reinvesting in the company to increase the value of each share instead. So these are really the two mechanisms in which value is returned to the investors. Dividends are good for the investor from a cash flow perspective, whereas the company reinvesting the money or doing share buybacks is good on a capital gains perspective, meaning that the value of each share the shareholder has increases. Either way, value is unlocked, which is great for the investor. We've mentioned most of these, but just to go over, why would we have a company? The limited liability, legally speaking, great benefit, right? Especially if you're worried about legal cases being brought against your business, having a limited liability really helps protect your private assets. And it's how you hear about famous businessmen who go bankrupt yet still have a yacht, a supercar, a mansion. It's because their private assets are separate from the company's assets. We mentioned this one as well, the increased access to financing. Whether it's a privately or publicly held limited company, there's still more access to financing than sole traders or partnerships enjoy. Banks are more willing to lend, and you have the potential to sell shares. There are potential tax benefits to running a company. Of course, things get complicated here. There's a lot of well-paid lawyers and accountants that work to not avoid, but minimize the tax the company pays, and they're quite effective at that. One thing that shouldn't be understated is continuity. Sole traders and partnerships, they very much rely on the people working within the business to keep it going long term. A corporation takes on a life of its own, essentially. And regardless of who is the CEO, who's on the board of the directors, who are the shareholders, operations tend to continue without any real disruptions due to individual people moving on. So it's really a big benefit of having a company. Some drawbacks is the increased complexity. Legally speaking, accounting-wise, the need to report. So it makes it not suitable for small businesses, right? You have to reach a certain size before it makes sense. We do have the potential for a lot of bureaucracy to be introduced regardless of the size. More paperwork, more controls, which can be a double-edged sword, good and bad, but it might reduce overall efficiency. We touched on this one, the requirement to report financials. There's essentially nowhere to hide. If the company's not doing great and you're a publicly listed company, everyone is going to know about it. You can't hide from that. That accountability is, again, a double-edged sword. It's good and bad. It means there's a big motivation to make sure everything is successful, but when things aren't going well, it can really be detrimental. In the case of publicly limited companies, especially, the founders can start to lose control of the company. There's quite a number of examples of this occurring in recent times, even where a founder of a company, their shareholding is diluted to the point where maybe they get kicked out as CEO of their own company in which they started. because the other shareholders have spoken, they have no faith in that person anymore, and they get booted out. This did famously happen to Steve Jobs in the 90s in Apple. He was booted out of what he considered his own company by the shareholders. Of course, he came back, and the rest is history. He was highly successful. Then we have the legal compliance costs. This can't be understated. It's very complex to set up and to maintain this structure. And like I said, it's not really suitable for small businesses. Medium to large enterprises and multinationals are the ones that this is suitable for. In the next video, we're going to continue looking at profit-based organizations, but this time social enterprises. In the new syllabus, there's a real heavy focus on social enterprise, especially for paper 1 and the 17-mark question, which is an action plan. So stay tuned for that one. If you enjoyed, please like and subscribe, and I'll see you next time.